Let's pick up with another topic that's related to accounts receivable. It's accounts receivable valuation. If I sold product to every student in the class, inevitably somebody's not going to pay for it. Somebody's not going to pay the bill. Businesses know this. They sell to thousands or millions of customers on credit. And why would they offer credit instead of demanding cash on the spot? Because they know that some of the customers aren't going to pay. They might go out of business. There's a risk there, right? The reason that they do it is because if they did not, their sales revenue may decrease. Customers have come to expect that credit is offered to them when they're purchasing product. And for most businesses, they can really consider this a cost of doing business. You know, I think about it like this. If you think about a billboard or some kind of advertising expense, why does a business incur these expenses? To increase sales, right? So we can look at this the same way. Why would a business run the risk of offering credit to customers when we know some of them aren't going to pay? Because we incur this risk and this expense in an effort to increase sales. Just like advertising, the same reason we pay employees to help us generate revenue is the same reason we offer credit. So if we think about it through that lens, we can understand conceptually how to account for this. I want to note this before we get into the proper way to account for this. Direct write-off. This is one approach, and it does not comply with accrual-based accounting. This means that if we sold product to a customer, we wait, we find out who goes out of business, who is not going to pay with certainty, and then we would write off the accounts receivable. That could be months or even years down the road, right? Let's think about a better approach and how an allowance method would comply with accrual-based accounting and makes more sense in terms of my favorite principle and yours, the matching principle. Hey, if we're selling product right now, in this month or this period, we know that we should have all of the expenses that are associated with generating that revenue recorded in the same period. Why? Because we want to match revenue with its corresponding expenses so that we can get an accurate picture of what our profit looks like. So when we are selling product and we know that some customers aren't going to pay, we know this. And that's an expense that relates to this sale in this period, and we need to record that uncollectible expense in this period. Think about if we waited months and years down the road. We sell product now, we have tons of revenue without any bad debt expense. Our net income looks awesome this year. And then next year, clients go out of business and we use this direct write-off method and then write off accounts receivable. Well, next year we have the entire expense that's related to these uncollectible accounts with none of the associated revenue. So we have an overstatement of net income this period, And we are understating net income later on when we record these uncollectibles through the direct write-off method. All right, so we talked about why the allowance method is superior to the direct write-off method, and this will be our concentration moving forward with a couple examples. The first example in the handout that relates to accounts receivable valuation is BE7-5. Let's take a look at that one. It says Wilton Inc. has net sales in year one of $1.4 million. At the end of the first year, this is before adjusting journal entries, the balances in selected accounts were accounts receivable has a balance of $250,000 debit balance. The allowance account, we'll talk about this in a minute, the allowance for doubtful accounts, allowance for uncollectible accounts, allowance for bad debts, all synonymous terms, the allowance for, and I'll just put uncollectible accounts. This was a $2,400 credit balance. Remember, this is at the end of the year before any adjusting journal entries. It says if Wilson estimates that 8% of its receivables will prove to be uncollectible. Now think about this. Over time, you kind of get a sense of the percentage of receivables that aren't going to be collected. Here, they've pinpointed 8%. And it asks us to prepare the end of year journal entry to record bad debt expense. First, let's think about this 8%. It says that 8% of its receivables will prove to be uncollectible. We've got $250,000 of accounts receivable at the end of the year. 8% of that is $20,000. So let's just stop right here and think about what this means. We have $250,000 outstanding. We are estimating that we will not collect $20,000 of that. So how much do we expect to collect? $230,000. Let's concentrate on this allowance for uncollectibles for a minute. The problem says that at the end of the year, before we make any adjustments, there's a credit balance in the allowance for uncollectible accounts for $2,400. The allowance account is a contra asset, similar to accumulated depreciation. It has a credit balance that reduces an assets balance down to a net asset balance. So in this case, ultimately, what we will arrive at in the balance sheet is we will have accounts receivable, and it will be $250,000. And then we will have an allowance account of $20,000, the amount we do not expect to collect. And then we will have a net accounts receivable of $230,000. This gives the financial statement user accurate information on a lot of levels. One is we keep this original balance separate from our allowance account so we can see how much we billed, and that's important to see how much we're not collecting. But most important for the users of the financial statement is to get an understanding of the amount we actually expect to collect, and in this case it's $230,000. So how do we make a journal entry to get here? We see that we have a $2,400 credit balance in the allowance account. We just saw that this needs to be $20,000, right? So our journal entry needs to bring up this balance to $20,000. That's $17,600. So let's take care of that journal entry, okay? The journal entry that we will make to account for uncollectible expense this period is uncollectible expense or bad debt expense for $17,600, and then the allowance for uncollectible accounts of $17,600. Let's pause for a minute and think about, how does this journal entry affect the financial statements? First, that uncollectible expense. This is the expense that relates to the sales this period. This is good. We're getting it in the right period. This is going to hit the income statement just like any other expense, reducing net income down so we have an accurate picture. The allowance for uncollectible accounts. We just said this is a contra asset. It's going to appear on the balance sheet, and through this journal entry, we now have a balance of $20,000. That's what it should be, because it's 8%, and our accounts receivable in the balance sheet is going to look like this, with net accounts receivable at $230,000. Let's look at another problem centered on bad debt, uncollectibles. This one is in the handout. It's BE7-6. We're using the information from our previous example with Wilton Inc. The first question says, instead of an allowance for doubtful accounts of $2,400 credit, assume that the allowance in doubtful accounts is a $1,900 debit. And assume that 10% of accounts receivable will prove to be uncollectible. So now we're in a position where we went over and above through writing off uncollectible accounts and put us in a position that's unnatural, I guess, where we have a debit balance in the allowance account. We've got a $250,000 accounts receivable balance. Here we're assuming that 10% of that is going to be uncollectible. That means $25,000 is going to be uncollectible relative to this balance. So in our allowance account, we want this to be at $25,000 after we make this adjustment. So what do we need to put here to get us to that $25,000 balance? We know we need $25,000, and if we have a debit of $1,900, that's going to bump up our journal entry to $26,900. So I'll use bad debt expense this time. It's synonymous for uncollectible expense, and this would be $26,900, and we'd have a credit to the allowance account for $26,900. When this hits the ledger, we're going to wind up at the right spot with an allowance balance of $25,000. The second half of this question says, instead of estimating uncollectibles based on a percentage of receivables, so think about this, we can go at this a number of ways. We've been estimating uncollectible accounts based on receivables. In this example, it says, assume Wilton prepares an aging schedule that estimates total uncollectible accounts at $24,600. An aging schedule is something that accounts receivable manager would use and the CFO would review on a regular basis to see, based on the age of all the accounts receivable, how old they're getting. Hey, if you have ever loaned money to a friend, they're supposed to pay you next day, you see them, the subject doesn't come up. Next week, you still haven't been paid. You're starting to get a sense that the likelihood of you getting paid as time progresses is decreasing, right? The longer it goes on, the less likely you are to get paid. Similarly, in a business setting, we would look at accounts receivable balances that say are 30 days old, and we would assume we're going to get most of these. But if it's been 60 days since we billed this, we would attach an uncollectible percentage that would be higher. If it's older than 90 or 100 days, we might say, you know what, maybe 10% is reasonable for 30 days, but our history shows that if these are aging beyond 100 days, we're not going to collect 50% of these. So we would have these numbers in mind, and based on the aging schedule in this problem, it says that aging tells us the balance in allowance for uncollectibles should be $24,600. All right, let's do this journal entry. Right now, in this problem, it says that there's a $2,400 credit in the allowance for uncollectible accounts. We're saying that this should be $24,600. So what journal entry do we need to make to get our allowance account up to where it should be? We're going to debit uncollectible expense for $22,200. That'll get us to the $24,600 that we need. This is going to hit the income statement as an expense, and then we will increase our allowance account by $22,200, bringing up the balance to the $24,600. Let's do one more problem that centers on uncollectible expense and the allowance for uncollectible contra asset. This is E7-8 in your handout. I think it's reasonable for you to be thinking about, well, this is nice that we record uncollectible expense when it happens in the right period so we can have that associated expense with the corresponding revenues in the right period, and also have a balance sheet that's accurate with that net accounts receivable, which is the amount we expect to collect. That's how it should be presented. But what happens later on when we find that a customer truly isn't going to pay? Like maybe a customer went bankrupt. There's no way we're getting paid. What do we do then? That's what this question centers on. It says at the end of the year one, RMS Company has accounts receivable of $800,000. And the allowance account is $40,000. On January 16th, year two, the company determines that a receivable from a customer, the customer's name is Ramirez Company, has a receivable of $6,000, and we've determined that we're not going to collect this. And management has authorized the write-off of accounts receivable. That's what we're doing now, the write-off of accounts receivable. So the first question asks us to prepare the journal entry for RMS Company to write off the Ramirez receivable. We don't want to debit uncollectible expense right now. we already did that, right? We don't want to hit that expense again because then we're double dipping on expenses. We already took care of it and we took care of it in the right period. So what happens now when we determine for sure Ramirez isn't going to pay? I'm going to start with the credit. You don't have to start with debits. Do whatever makes sense. It makes sense to me if Ramirez is not going to pay, we can get rid of the receivable. So let's just take care of that. It's $6,000 credit. Now, let's think about the debit. If we know they're not going to pay, we don't have to allow for this future uncollectible. So here we can debit the allowance account for $6,000, and this is our write-off journal entry. Let's talk about it for a minute. How does this affect the income statement? I don't see an expense, I don't see revenue. These are both balance sheet accounts. This is good because we already took care of the income statement effect when we should have in the right period. So both of these are balance sheet accounts. Follow-up question is, how does it affect the balance sheet? In the handout, it asks, what is the net realizable value of RMS's company's accounts receivable before the write-off? So let's do that. Before the write-off and then after the write-off, okay? Before, net accounts receivable. So net accounts receivable was $800,000, and our allowance account was at 40. So we would have had a net accounts receivable before this write-off of $760,000. Let's think about this after the write-off journal entry. What would our accounts receivable balance be? Well, it would be $800,000 minus this credit of $6,000. So accounts receivable would be $794,000. What would the allowance account be? Well, here we debited the allowance for $6,000. We had a balance of $40,000 credit. So our new balance is going to be a credit of $34,000. So after the write-off, what would net accounts receivable be? Same, $760,000. We just have a different balance in accounts receivable. We took care of the Ramirez write-off for accounts receivable and the allowance account. The big takeaway is we took care of the write-off. Our net accounts receivable is the same, and it doesn't have any effect on the income statement. Why? Because we took care of that component when we should have during the period to match expenses with revenues.